Mahesh Nandurkar joins us. Let's talk budget, let's talk markets, and let's talk about what he's telling his clients after the 6% value. Mahesh, good morning. Thank you for joining us. Mahesh, do you think markets have overreacted to a good budget, or this is a normal reaction and it could be called as a relief rally as the budget has turned out to be a no-harm growth-oriented budget? Would you justify the last 24 hours of move as sentimental driven or fundamental adjustment?
Yeah, I think, as you rightly said, it's a kind of a relief rally in a sense that, as we entered or as we went into the budget, the expectations, I must say, were quite low. And as we've seen the Indian market had corrected by about 6% or so in the previous week. And we were underperforming. So to that extent, there was some element of skepticism. And, after seeing like so many budgets for the last so many years, which turned out to be non-events, this one was not. And, clearly, no nonsense budget, a very honest budget, I would say. And honesty is a virtue, very, very little, things which appear to be like hanky-panky, etc. So, a very, very clean budget in that sense. And yes, growth oriented, at that. So yeah, I think multiple sort of positives came in, and with the low expectations. So yeah, I would say that the 5-6% move that we've seen in the market since the announcement of the budget is probably a kind of a relief. And where do we go from here? My sense is that still the trend is on the upside.
Your personal question, I just realized that there is a giant, not giant, like a mega book wall behind you. How many books are there on that wall, Mahesh? I mean, I'm just looking at the screen and trying to understand what, 500, 1,000, 1,500?
Well, my plan was to utilize this lockdown to, read a lot of books. But unfortunately, this working from home environment is not that kind, and it actually takes away a lot of time. So you hardly get any time.
But still, how many books are there? I'm curious. I'm just trying to count. My producer is saying it should be at least 700. I'm saying 1,500 plus.
Yeah, even I have to sort of, make that count. So, I can't, tell that to you. I don't know that myself.
Okay. I'll love to talk. You're the man with numbers, but I'll keep this number judging for our next conversation. How many books are there on that wall? We'll play this assumption and the number game with you next time. Back to markets, Mahesh. What are you telling your clients now? I mean, should they seriously look at increasing their positioning in India? Because here's one economy which gives you a proposition of growth, credibility with numbers, and a scope of strong earnings recovery. Do you think the India case now on a relative basis is stronger than ever before?
Yes. So the thing is, I personally believe that we are at the beginning of a multi-year cyclical upturn in the economy, which I think will initially be driven by housing and then will spread to the broader corporate capex and infra capex as well. And in that sense, the budget of yesterday clearly sets the direction very clear. So my sense is that yes, so one clearly needs to be optimistic still on the cyclical recovery names, be it like banks, industrial, property developers, materials, etc. So those are still the sectors that I find interesting. Because I do feel that globally the environment still continues to remain conducive. And definitely in India, I believe, as I said, we are at the beginning of a multi-year economic revival cycle.
Mahesh, so what happens to IT? There is a natural tailwind there which is global in nature. What happens to pharma? I mean, right now, yes, infra spending will benefit industrials and cyclicals first, but it's not that IT will not grow or pharma companies will not grow. There is a pent-up demand for IT which is global. The healthcare spend has also increased. That's in budget allocation. Somehow nobody is speaking about it. Everyone is saying buy corporate banks, look at L&T, don't look at Infosys, but revisit perhaps an ICICI bank. Is that narrative right?
Well, okay. So, I mean, I'm just talking, from, our perspective, Jefferies' perspective. We have been, sort of pushing the cyclical story even before the budget and even before, later in the later part of 2020 itself. So, it's not that there is any big change of stance that, we are talking about here. But anyway, so talking about, the other defensive sectors or, even IT. IT is not technically a defensive sector because, as you rightly mentioned, there is a global recovery angle there. There's a US economic recovery angle there for sure. And so to that extent, as we talk about, US economic recovery and the spending happening over there, it is clearly going to be a tailwind for the Indian outsourcing companies, IT services companies as well. But having said that, I would say that, at this point in time, while the market as a whole is trading at a multiple which we have never seen. Nifty is trading at about 22 times and much higher than the historical averages. But so is the case with many other sectors. And if you look at IT services, the valuation premium is even more than what we've seen for the market, on an average. And at the same point in time, I would say that if you look at the earnings growth, potential going forward, it is still between 12 to 15%. So it's not that those very, very high multiples are on the base of, are on the basis of a pretty strong earnings growth. The earnings growth is, still on the lower side of what the broader market earnings growth expectations are. So I would say that, at best, I would be neutral on IT services. And I'm not kind of discounting the long-term story here, but clearly the way to play the market here, I mean, not just now, but I would say over the next few years, I would say would still be, which are the areas, which, did not perform, well over the last 5 years because of the investment down cycle. And I think that seems to be changing at the margin. So I would clearly be positioned more optimistically on those sectors.
Okay, and let's talk a little bit more about those sectors, Mahesh. There were also so many pockets which have been beaten down, didn't really receive a mention in the budget this time. If we were to look for, disappointments, there would be a number of sectors that perhaps are looking for some sops or some relief. But which are some of these pockets that you feel will deserve a relook?
No, I think some of these stocks and sectors have already been doing pretty well over the last 3 months or 6 months or so. Now the sector that probably did not really receive as much of attention in the budget is the property sector. I mean, yes, the government did announce a few measures on the affordable housing ones, but if you look at the listed space, those are not really the stocks that really benefit as such from budget announcements as such. And yes, while those stocks have done well in the last 3 to 6 months, but I think it is coming after a period of almost a decade of underperformance. So property developers still remains the top sort of sector or the top overweight sector for us. Apart from that, as I mentioned, we do like the industrial names, which are obviously getting some positive mention from the budget. Even within the industrial name, there are some that are a potential disinvestment candidates as well. And I think the narrative on the potential disinvestment side, the strategic disinvestment side, hasn't really changed. And I think there are clearly some opportunities that will be thrown up from that side as well. So I would say that one should be looking at some of those potential disinvestment candidates. There are some select PSUs that one need to look at as well. I believe that one should be at least equal weight on the PSUs from here on.
Okay, so an equal weight coming in on the PSUs then, and specifically on the financials, if we were to sort of dive in there, given the, and we've been talking about, of course, the divestment agenda, the cleanup plan and so forth, but what's the kind of pickup you anticipate given now the focus on growth, the focus on the cleanup, and the financials is a pocket that has otherwise been lagging quite severely?
Yeah, that's true. So, banks and financials, is one of the sectors that, looks pretty interesting to me. And I think what we've seen in the recent, result season is that the asset quality is, holding up, quite nicely, maybe in fact, a tad better than what the initial expectations were. The restructuring levels were low. And I think that is still one segment, in the market. So I would say banks, certain industrials is still the segment of the market where the valuation, still appears, quite reasonable. So that is definitely, a segment to be looking at. And I would say that as we talk about this broader, economic recovery and the housing-driven recovery, etc., it usually bodes well for the asset quality as well, because many of the small businesses, and their loans and what they mortgage are ultimately linked some way or the other to the property sector. Maybe there is some property asset that would have been mortgaged, etc. So the banking space kind of clearly benefits on account of the cyclical recovery. The credit growth should slowly begin to improve. So yeah, I mean completely with you on that.
Mahesh, the one thing that we've seen in the earnings season so far as well is the rising pressure on raw material costs because of the uptick, and a very sharp one at that one has seen across commodity asset classes as well. Are you worried a little bit about the margin impact that this would have on earnings growth?
Yeah, true. Very true. As we're looking at the global recovery setting in and Indian recovery setting in as well, there will be slowly the pressure of inflation, the raw material inflation will begin to come in, and my sense is that it'll begin to be more more kind of a powerful force to reckon with towards the second half of the current calendar year, where the YOY comparisons will also become slightly kind of more not so helpful on the raw material side. But the point is that in an environment of economic recovery, there will be revenue growth improvement as well. And let's not forget the operating leverage concept, because as the revenue growth improves, it will naturally give support to the margins. So yes, the raw material prices going up is definitely a concern, and we clearly need to be worried about, or we clearly need to be watchful about what kind of companies and what kind of sectors have the capability to pass on the cost push in the form of price hikes. So that is going to be one incremental factor to be kept in mind, that the market share trends and the trend of competitive dynamics in a particular industry, and whether a particular company has the ability to pass on the cost push or no, because that is going to be critical. But yes, I think the revenue growth improvement will also help the margins to be sustained.
Sure. Mahesh, when you say that you're positive on property, given how diversified this very limited listed space is, what is it of interest to you? Because what the budget announced was clearly affordable housing. I mean, I know discretionary income is going to find its way eventually into the luxury homes as well, and also the large ancillaries that come along with the real estate segment. That's, your paints, your tiles, sanitary ware, what have you. So what within this large gamut interests you?
So in the larger gamut, I still feel that the best way to play is still through the property developers, because that gives you the most leverage on the property cycle. The building material and the other ancillary plays, as you mentioned, obviously benefit as well. But the extent of leverage that they have on the property cycle is that much lower. So I would say the best way to play is still through property developers. And within that, I would be focusing more on the residential players, because that is where the maximum upswing is going to be, in my view. The commercial developers will benefit eventually, But my top picks would be the companies that have a more residential portfolio.
Mahesh, is this market reminding you of what we saw between 2003 and 2007 or 2004 and 2007, where we had a big surge in asset inflation? We saw a big uptick in infra spending. We saw a complete focus on infra, which re-rated a stock like L&T, BHEL, a Siemens and a Thermex. Are we in for that market cycle again?
A very, a very interesting question, Nikunj. I would say that many similarities. So I would say there are a lot of economic similarities, and all the factors that you mentioned about the property cycle upswing, the infrastructure and the other capex cycle revival, the asset quality pressure on the banking system beginning to go down, etc., and the GDP growth revival, etc. So there are a lot of economic similarities. And also to the extent that the rates having bottomed out, the yields having bottomed out, and probably the yields are going to go up from here, etc. But the one thing that is not exactly the similar towards 2003-4 is the market valuation. And what is the starting point? So at that point in time, the market was trading in single digits, about 8 to 10 times P multiple for the market as a whole, and many stocks were in low single digits as well. Whereas today, the Nifty trades at about 22 times, and many stocks trading like 30, 40 times, etc. as well. So the market valuation is something which is different now as compared to then, but there are a lot of economic realities which are very, very similar.
Mahesh, when the pandemic happened, everyone said, okay, the world is going to go digital. The relevance of old companies will completely evaporate. Now we are saying go back to infrastructure, look at industrials and cyclicals. Sometimes when I look at how divergent and how fast the market opinions are changing, it's quite amazing. From a digital only world which was getting ready because of the pandemic shock to go back to industrials and cyclicals. How ironical is that? Don't get me wrong, but I'm just trying to bring facts out. In 9 months, what variation we've seen?
No, true, Nikunj, and we all being market participants have to clearly respond to the facts as well. So we can't really be sitting in isolation and just cling on to our views, what we thought was the correct view, say 6 months back or 1 year back. And as you rightly mentioned, the pandemic was obviously completely a different ball game, and obviously it was one of its kind, right? That one sees in a lifetime, and hopefully not again. But I mean, at that point in time, we wouldn't have imagined, say, the disbursal growth for mortgage companies being 20% plus in the December quarter, or cement demand, growing at like close to 10% and things like that, or the cars and the CVs and so on. So the economic response has changed in the last 6 months. So the market is clearly responding to what has happened, and clearly I don't think we would have expected back in say May or June that the GDP or the broader economic activities would come back to pre-pandemic level as early as say November or December or something like that. But that has happened. But having said that, Nikunj, I think one thing that this pandemic has clearly taught us is that we can work from home, we can do schooling from home, we can do so many things online. And I think that is clearly going to have an impact for sure. So I still believe that the adoption of technology and internet has been accelerated by this pandemic. And what we are clearly looking forward to is that while there have been many attractive listed companies globally and in China, but we haven't really seen that many companies in the Indian listed space, as such. Hopefully, the Indian investors, the listed market investors, will get more such options to participate in this booming internet story over the next say 12 months or so.
So Mahesh, on a fall like the bad patch we saw last week, because of global cues of pre-budget nervousness, we did get a bad patch. What would be your inclination where you should what is your inclination? What would you tell your clients that they should be buying infra, cyclicals, or they should go back to IT and pharma? What should be what should be a portfolio balance for next 3 years?
No, so as I mentioned, Nikunj, I'm a firm believer that we are in just the beginning of what I call as a multi-year economic recovery, multi-year upcycle here in India. And as I mentioned, I think housing is going to be a central part of this thesis. So my focus, if I take a 3-year view or even a 5-year view, but at least from a 3-year view, I'm definitely going to take a pro-cyclical stance here. And I'm going to be, a buyer of, as I said, property developers, banks, industrials and infrastructure companies. I think that is clearly going to be my portfolio, a large part of my portfolio, if I take a 3-year view.
Okay, so clearly, of course, those are the pockets that you are continuing to track. Mahesh, leave us with, a revised, outlook or target. I don't know if you're going to give me a target, but let's say a year end from here, given the kind of acceleration on growth, where do you feel equity markets may just land up?
No, our official, year-end target for Nifty for December 21 has been 15,800. And that continues to be the scenario. And that is based on our assumption that the yields in India, the risk-free rates will move up to about 6.5%. That is still my central case. If, we actually see the yields, not moving up to that level, the upside could be higher, but obviously it's the other way around as well. Yeah, so somewhere around 16,000, for Nifty is what we will be looking at for the December 21. But within that, obviously some of the sectors that we already discussed should give a much higher upside.
All right. Mahesh, thank you so much for joining us this morning.
Thank you very much for having me here.